Next up, we have Rob Bennett. He is a two-time Ignite FinCon speaker, and he is here to tell us how to predict stock returns for fun and profit.
Hello. Being able to predict stock returns is investor heaven. If you know what your return's going to be before you put your money down, you've essentially eliminated risk from the equation. Most people think it's not possible, but the reality is there is now 33 years of peer-reviewed research showing that it is entirely possible to make highly reliable predictions of long-term stock returns. The confusion stems from research done by Eugene Fama in 1965. Fama showed that short-term timing, changing your stock allocation because of a belief, walk this way, because of a belief. Oh my goodness. Okay, Fama showed it's not possible to do short-term timing, but Schiller showed that it is possible to do long-term timing. This is a graphic showing, comparing valuation-informed indexing, the Schiller strategy, with buy and hold. And it showed that over the 140 years of stock market history available to us, valuation-informed indexers have been able to earn the same returns as buy and holders while taking on much less risk, or by taking on the same level of risk to earn much higher returns. This blue line tracks PE10, the Schiller valuation metric. Now you'll see that every time there's a spike in valuations, we experience an economic crisis in the years that follow. There was a spike in the 1920s and then the Great Depression, a spike in the 60s and then the stagflation of the 70s, a spike in the 1990s and then today's economic crisis. Why? The recent research shows that overvaluation is pretend money. It disappears over time. So when trillions of dollars of spending power are taken out of the economy, tens of thousands of businesses fail, millions of workers lose their jobs. This is a regression analysis showing that as stock valuations increase, long-term returns come down. And that's exactly what you should expect looking at this from the standpoint of common sense. With anything you buy, the price you pay is a big factor in the value proposition you obtain with that purchase. The good news is the maximum drawdown number. Maximum drawdown is an excellent measure of risk. The maximum drawdown is the greatest percentage loss you will experience in your portfolio over the course of an investing lifetime. For buy and holders, it's 60%. For valuation-informed indexers, 20%. So you reduce risk by two-thirds by making this one change. You only need to change your allocation roughly once every 10 years for this to work. This graphic shows the story that applied in 1982 when prices were rock bottom low. The most likely 10-year annualized return on stocks was 15% real. You would get 15% on average for 10 years running. You can finance a retirement in a very short amount of time with that sort of return. The opposite situation applied in the year 2000. The most likely long-term return on stocks purchased in the year 2000 was a negative number. It's a little better today. It's a positive 1% real, but you could do as well in a money market account with much less risk. The next graphic shows the story for retirees. Say that you retire at age 65 with $1 million in your portfolio. You want to know, how much can I take out every year to cover my cost of living in retirement? What determines it is when you retire and what the valuation level is at that time. If you retired in 1982 when prices were low, you could take out $91,000 a year. That's a pretty darn nice retirement. If you retired in the year 2000, you could only take out $20,000. Big difference. The recent research shows that the valuations factor is probably 80% of the stock investing story. If you get valuations right, it's almost impossible to do poorly in the long term. But the other side of the story is, if you get valuations wrong, it's almost impossible to do well in the long term. Buy and hold can work for significant stretches of time, or can seem to work. but the valuations factor always catches up with investors who ignore it. The Shiller model predicts another stock crash within the next year or two. I believe at that time people are going to lose confidence in buy and hold and make the shift to valuation-informed indexing, the first true research-based investing strategy. Thanks for listening.
Rob Bennett, everybody. Give it up.